$3 million missiles versus $50,000 drones. Inside the US-Iran war cost crisis. Do you know what happens when a global superpower enters a conflict where the baseline mathematics create sustained fiscal strain? We are no longer observing a contained regional confrontation. We are witnessing the early stages of elevated systemic risk across energy markets, defense budgets, and global trade architecture. Energy markets are actively repricing geopolitical risk, and American households are positioned directly in the transmission path of that repricing. But beneath the headlines lies a deeper structural pressure point, the asymmetry of modern combat economics. The United States is deploying interceptor systems that cost between $1 and $3 million per launch to neutralize drones that cost roughly $50,000 to manufacture. That imbalance, millions against tens of thousands, introduces long-term budgetary strain if sustained over months rather than days. This is not simply a battlefield dynamic, it is a financial one, what we know so far. Over the past 72 hours, escalation has intensified sharply. The United States and Israel conducted coordinated strikes targeting Iranian nuclear infrastructure at Fordow and Isfahan. Iranian leadership structures were heavily targeted. Tehran responded with ballistic missile and drone strikes across Gulf-based U.S. military installations. Al Udeid Air Base in Qatar has been targeted. Naval facilities in Bahrain have reported impacts. Regional airspace closures across Qatar, Kuwait, Bahrain, and the UAE have disrupted civilian aviation corridors. Oil markets reacted immediately, with prices moving from roughly $70 toward $80 per barrel as risk premiums expanded. These are measurable signals of instability. Markets respond not only to destruction, but to uncertainty. The asymmetric cost equation. To understand the deeper economic mechanism, examine the numbers. The U.S. military relies on high-end interceptors such as THAAD and Patriot systems. Each launch can cost between $1 million and $3 million. Iranian drone platforms, including variants similar to Shahed systems, are estimated to cost tens of thousands per unit. If interception requires multiple launches per incoming drone, the burn rate compounds rapidly. A sustained exchange introduces modeled fiscal strain on replenishment cycles, supply chains, and congressional appropriations. This does not mean the Pentagon collapses. It means sustained engagements reshape defense budget allocations and procurement timelines. Capital markets are already responding. Defense contractors are experiencing increased investor attention as replenishment demand rises. The Strait of Hormuz, structural exposure. The Strait of Hormuz remains the critical choke point. Approximately 20 million barrels per day, roughly 20% of global crude flows, transit this corridor. There is no confirmed full closure. However, insurance premiums, shipping risk, and tanker routing behavior are sensitive to escalation probability. Oil moved sharply higher following initial strikes. That movement reflects risk repricing, not yet confirmed supply destruction. The transmission channel is mechanical. Oil, gasoline, diesel, freight, food, CPI. If oil sustains elevated levels, the pass-through effect becomes visible at the pump within weeks. The Strategic Petroleum Reserve modeling suggests the U.S. Strategic Petroleum Reserve could offset a severe disruption scenario for roughly 30 days. Beyond that, the market would rely on rerouted supply and production increases. That is not a countdown to collapse. It is a buffer window for stabilization. Household exposure. For American households, gasoline operates as an immediate purchasing power adjustment. Higher fuel costs act as a regressive pressure on discretionary spending. Diesel costs influence freight rates, which affect grocery pricing. The effect is incremental, but cumulative. Federal Reserve constraint. The Federal Reserve faces a structural dilemma if energy-driven inflation re-accelerates. Higher oil lifts CPI expectations, pressures bond yields, influences mortgage rates. Rate cuts become more complex if inflation expectations rise. Rate hikes become more painful if growth slows. This is not a collapse scenario. It is a policy constraint scenario. China's strategic position. China purchases the majority of Iranian oil exports, often settled in yuan. Beijing's long-term Belt and Road corridors depend on regional stability through Iran. China's Beidou satellite system provides an alternative navigation network. Reports suggest expanded technological coordination in the region, though specific battlefield integration claims remain subject to verification. China's strategic posture appears calibrated. Avoid direct military entry while preserving energy architecture. Russia's position. Moscow views Iran as a strategic counterbalance in the region. Energy geopolitics and European supply dynamics factor heavily into Russian calculus. Publicly confirmed assistance includes diplomatic backing, Gulf structural vulnerability. The Gulf Cooperation Council economies rely heavily on global trade and desalination infrastructure. These are exposed assets in any sustained regional conflict. That does not mean systemic collapse within weeks. It means elevated fragility if infrastructure targeting expands. The petrodollar recycling question. Petrodollar recycling refers to Gulf sovereign capital reinvested into U.S. financial markets. If regional instability forces large-scale capital reallocation toward domestic defense spending, liquidity flows into U.S. equities could adjust. That represents potential equity market structural pressure, not guaranteed collapse. Escalation modeling. Baseline case. Contained strikes, elevated oil volatility, limited infrastructure damage. Prolonged case. Repeated exchanges, insurance spikes, oil $110 to $130 range modeling. Severe case. Physical choke point disruption, global supply rebalancing stress. Each carries probability ranges, none are certainties. If sustained, this conflict accelerates. Defense spending reprioritization, energy redundancy investments, supply chain diversification, currency settlement experimentation. This reflects long-term realignment, not immediate systemic failure. The core question is not whether headlines feel dramatic. It is whether the cost asymmetry remains manageable or becomes structurally destabilizing over time. The United States retains overwhelming tactical superiority. The question is financial sustainability under asymmetric burn rates. In periods of volatility, disciplined structural analysis matters more than emotional reaction. Subscribe to ETN if you want continued modeling grounded in probability, capital flows, and transmission mechanics. We analyze escalation without hysteria.